do with where countries were to begin with. I think the commonality is that there are very few countries where this is being driven by fiscal policy, because generally speaking, the government is in retreat because of the debt situation. And much of the recovery from COVID has had to be picked up by the private sector. The private sector itself is supported by, I would argue, conducive monetary policy, but that is changing, and that's changing fast because of the inflation outlook. And so there are a number of kind of, I guess, potential headwinds depending on how quickly monetary policy tightens. Next slide, please. And this is, I'll skip over this one because this is the point I was making. We see monetary policy adjustments tighten quite fast across the continent. If I could, actually, maybe one point to make on this. So there are about 10 countries across Africa, which we think are the top 10, we call the top 10 performers. And these are countries that demonstrate growth of more than 6% in 2022 with factors that we think are quite durable. And we list them over here. Senegal, 8.1, and Senegal's experiencing a very strong growth boom based on what's happening in its hydrocarbon sector. Countries like Niger, Congo DRC, which stands to benefit from this critical minerals boom, Rwanda, Cote d'Ivoire, Benin. So we have a good portfolio, I would say, of countries that have that are demonstrating growth that is far superior to what other countries in the world are seeing. I mean, these are growth rates that are higher than what China is expecting to see this year. But on the flip side, you have the big three, South Africa, Nigeria, and Egypt, which account together for almost 50% of continental GDP. And these countries have continued to struggle for internal, sort of mostly structural reasons. So it's a good thing we're focusing on Nigeria today, because we can just sort of drill down a little bit into what some of those structural drawbacks are. On to the next slide, please. Right, okay, so let's just take a look at Nigeria. As Oguche rightly pointed out in his introduction, this is a pretty pivotal year for us. And just to remind us about the macro backdrop against which this election occurs, the first one is obviously mounting fiscal pressure. This is not a new story. It is also the story that has largely driven the recent Moody's sovereign downgrade. And fiscal pressures are linked to some long-standing structural problems to do with difficulties in raising non-oil revenues, but these are much more exposed in a year like this because of the difficulties that we've seen on the oil side, oil production side. So lots of oil leakages, chronic underinvestment, starting to finally kind of combine in terms of this very difficult production story. And this plays out in terms of debt affordability metrics. For the first time, Nigeria is starting to demonstrate, so debt affordability has typically been weak when you focus on non-oil revenues. But with oil revenues so low, total revenue to revenue interest coverage is something like 50%. So roughly 50% of total revenues in the outlook period 2023 and beyond is going to service debt, and that starts to look quite. It starts to look like a quite stressed position, even though debt ratios are low. And then, of course, there's the subsidy overhang, because what little oil revenues are coming into the FGN have largely gone to service the subsidy payments. And the next slide sort of just sets out, I guess, let's remind ourselves of the figures. So you've got real GDP growth, like I mentioned, which is still pretty, I would argue, robust, despite the fact that you have oil GDP on the bottom slide that is a drag. It's really a drag on the economy, and it's the non-oil sector that's essentially been carrying this economy over the last 5 quarters. Now, when you look at what's really supporting in the non-oil economy, it's basically the agricultural sector and to some extent services. But a lot of the other traditional strong performers are also under pressure. And this is, we start to see the impact of the drag from the oil sector, the FX problems, having a real negative sort of feedback loop in terms of non-oil GDP. Okay, so, right. I think this chart is helpful for us to consider in a long-term context what is happening to oil production. For those of you on the call who are less familiar with the story in terms of oil production, obviously oil revenues, oil production and oil revenues are an important source of foreign exchange. The sector itself has been shrinking as a share of GDP from something like 15% of GDP more than a decade ago to less than 5%, mainly because of this picture. Okay, so we have a sector that is experiencing significant oil bunkering, or the sort of tapping, illegal tapping of oil pipelines, meaning that on the whole, Nigeria is not able to export as much oil product as it should be, because by the time the product gets to the terminals, essentially it is a tiny fraction of what has actually been extracted. So when you look at the latest period since 2020, we have seen probably the sharpest and fastest decline in production numbers, bringing us to levels that are consistent with the early 80s, when we had that sort of crisis in the early 80s. Now we have last few months of last year, in November and December, the anecdotal evidence is that production picked up slightly, and some analysts have been pointing at this as evidence that we've finally turned a corner in the sector. But it's important to try and understand the factors behind the pickup. From everything that we can tell, these are not necessarily drivers that we can point to as having a durable impact on production. When you look at the major, at least from data that we've seen in terms of the receipts of the major oil terminals, the largest oil terminals, most of them are still operating at a very, very low capacity. And this uptick is essentially driven by one terminal and its broader network, its broader system. And there is no evidence that there are, again, fundamental structural changes within the whole system that will be able to address this bunkering issue. So our outlook for the oil sector continues to be fairly bleak, at least in 2023 and beyond. We think that from a policy point of view, there are probably 3 things that the next government needs to prioritize. The first being securing the oil sector, securing production. The second is essentially addressing the subsidy issue, and the third is, of course, what's going to happen with the FX regime. All right, so quickly moving into the next few slides. I'm almost done. Let's talk about monetary policy and, by extension, exchange rate policy. Oops. Okay, so if my memory serves me correctly, what the next slide shows is...
I think they're getting to it in a second.
All right, okay.
All right, you can just pause. I think they should have it for you shortly.
Okay, so obviously we've just had the CBN raise rates to a nearly 20-year high of 17.5%. So that was a January action that they took. The other thing that I find interesting about this slide is we we looked at what has typically happened to monetary policy in Nigeria over the last 5 elections. Okay, and in every case, in April 2003, so this is the change in the monetary policy rate in basis points in the year prior to the election. And you can see that for the most part, policy has been in an easing mode, okay, in the lead up to an election. A few exceptions, maybe 2011, 2015, but again, not a massive increase in policy rates. So that then makes this particular election somewhat of an outlier. And it's important to consider, I guess, the context that we're in, okay? Because, sorry, I can hear there's quite a bit of feedback. So if somebody is not muted, perhaps they could do that. So the next slide will provide some context for why this is probably one of the most it's the tightest monetary policy. Well, on the margin, monetary policy is heading into a tighter mode. Part of this reflects what's happening externally, but if we consider what's happening domestically, on the right-hand side, there is a picture of inflation, and inflation rates still remain at levels that are significantly higher than historical averages. On the left-hand side, that's a picture of real yields, and the sense is that obviously policy is still quite accommodative, and there's still a lot of liquidity in the system. Of course, Oguche mentioned what's happening with Naira redesign. So I think that what will probably happen through the latter part of this year, as these impacts start to take shape, actually not even the latter part of this year, we're probably going to see this as early as Q2, because the redesign, the exchange of notes has been extended now for another few days. Is a massive sort of tightening in liquidity, extraction of liquidity from the system, combined with, I guess, a pace of tightening that, depending on how much this impacts inflation, we could or could not see more tightening ahead. But the factors, holding everything else constant, I think the factors are supportive of what the CBN is doing, which is essentially tightening a lot more. Now, the impact, obviously, going into the latter part of this year is for stronger Naira, okay? And from a reserve accumulation point of view, we don't have slides on that, but we know that over the course of 2022, the CBN lost something like $3.5 billion in reserves. There was no Eurobond issuance. So and if you live in this economy, you know that you experience day to day the FX shortages, right? And this is something that's affecting businesses. And so the need for tighter monetary policy and liquidity tightening, I think, is something that will, within the current system, within the current FX regime, help to sort of pull the parallel rate in somewhat, and also sort of put a floor under the very sharp reserve loss that we have seen. Now, what happens following the election is anybody's guess in terms of policy shifts, right? Because all of the major candidates have talked about making adjustments to the exchange rate regime. I think these marginal changes in terms of the redesign, the tighter monetary policy, buy a little bit of time. By that I mean is they put a floor under the sharp depreciation that we saw last year, and also the kind of the reserve loss. But how much time that is anybody's guess. And I guess nobody knows. Nobody knows what the policy outcome will be in 2023. The other thing to note is that realistically, from a timeline point of view, By the time the new government settles in, this is probably H2 2023 when they'll start to look at policy. And I personally don't see any kind of major policy action happening before early 2024. So we're in a kind of a wait and see mode for 2023. But of course, we still have this picture of an elevated international oil price environment that's not translating into benefits from a macro point of view. It's not translating into higher reserves because all of that is being eaten up by subsidies. There's a slide on the graph on the left which looks at crude price and the proceeds, FGN proceeds from exports, and demonstrating the fact that much of the revenue that the FGN earned went to subsidy payments. And this is contributing, as I mentioned earlier, to the debt affordability problem. But actually, when we start to consider external risks, we see a few sort of mildly positive factors. One, the fact that Eurobond amortization is fairly supportive. The FGN only has to come up with $500 million in terms of debt service on Eurobonds, and then much of the rest of the debt is multilateral to multilateral, so not as expensive. The key factor is that with its current rating, Nigeria is effectively locked out of Eurobond financing markets, which have been essentially the main source of hard currency in recent years. So I'll stop there and I'll wait until the Q&A. Thank you.
Thank you very much, Dr. Rita. Very valuable indeed. And I personally have some questions to the last point you just made, but I'll save them for now. And as she mentioned, we are going to have a Q&A segment. So please endeavor to type in your questions in the Q&A field, and we'll get to them later on. But for now, I'd like to invite our next presenter, who would be giving us some perspective on the equities markets. And it's none other than Mr. Muyiwa Oni, who is the Regional Head of Equity Research, West Africa for Stanbic IBTC Bank, which is a member of the Standard Bank Group. In his capacity as member of the analyst team, the clients for the West African equity research business are primarily made up of offshore frontier market institutional investors and domestic institutional investors. He has over 17 years experience in sell-side equities research with a background in the building materials and oil and gas sector. But prior to that, he worked in IBTC Asset Management Limited as a buy-side analyst, supporting portfolio managers. So he's been at this for quite a while. He also has experience in the oil and gas and petrochemicals and food sectors. He is also, I'm happy to say, a top-rated analyst by Financial Mall. On that note, I'd like to invite Muyiwa to make his presentation.
And thank you very much, Wale, for that kind introduction. And thanks, Rita, for sharing the context on the Nigerian economy. Can you enable my ability to share slides? I have a few slides to share, but it seems I have some admin restrictions. So if you can please enable that. So
I'm sure they will enable it in a moment. So just give them a second, but perhaps you could just help us, set the tone. What should we expect in your presentation?
Oh, sure. So my presentation, I'll talk through 4 areas. One, share some perspective on the performance of the African equity market. And really just highlighting how Nigeria has performed over the long to medium term, and also flag year-till-date performance would look through outlook on earnings for the Nigerian market valuations as well. Talk through liquidity insights, key drivers, so what both domestic and institutional investors are doing, and then end with some sector calls. So from an SBG securities perspective, areas we like, and some of our top picks as well. Not sure if, okay, so I think my slides are up. So on the next slide, we show On the next slide, we show the performance of some Africa indexes over the past 10 years. And I think what's interesting is that if you look at the performance of the NGX, that's a Nigerian stock exchange, it's actually done fairly well from a domestic currency perspective. So over the past 10 years, returning close to almost 200%. Last year, 26.4%. So performance last year just behind Egypt, and for the past 10 years as well, behind Egypt. If one is looking at the hard currency, so in dollar terms, the story is different, and I suppose if you look at how the currency has depreciated in the official market now over the past number of years, I guess one can explain why. Suppose if you apply the returns using parallel market rates, then one could easily see negative returns for a number of years as well. But overall, if one is looking at the local market from a peers perspective, performance has been reasonably decent. And I was still having a chat with a US-based investor a couple of days ago, and because there was that question of why the country's market is still returning so well. It seemed to be the view that with high inflation, investors are still thinking of where to generate real return. So if you go on to the next slide, here we more or less still talking about the African performers. And I think what's interesting within that space is that the Nigerian, there are quite a number of strong performance from Nigerian names over the past year, from the brewers to a few banks, the Seplat Oil and Gas Company, which I think that should, one understands that given the strong performance you've seen from an oil perspective, and so if one looks, so I think what's positive about this is that in spite of the negative flows, so you've seen foreign portfolio flows leave the market, and I have some slides that show that in subsequent slides, but the market still seems to be holding up in spite of that, and I suppose shows some level of resilience, I would argue, from a domestic player point of view. And if you look at this year, so I didn't have it sent through. I'd updated the slides on my own deck, but you see that the Nigerian equity market is still faring pretty well this year. So up about 4.4%, just behind, only behind Egypt. If one is looking at the major African market, Egypt up 13% so far this year. Quite strong. The other African markets have underperformed, quite a number of them performance negative. So if you look at the GSC, down about 1.3%, that's the Ghana Stock Exchange, the BRVM as well, down 1.2%, Nairobi pretty much flat, the Mauritius Exchange down over 2% or almost 3%. And if one look at the MSCI Africa XSA, also showing negative as well. So the next slide goes into Nigeria and what we think for earnings this year. I think it still shows why valuations still look attractive and supportive. So for this year, earnings expectation for the market is about 18%. And even for next year as well, we expect further growth as well. So this in spite of some of the challenges that seem to be coming through from inflation. So Rita highlighted the concerns on inflation that seem to have a negative impact on margins for quite a number of the players. But what we see as well is that I think for this year, we expect the banking sector to drive some of the earnings growth, given expectations on higher margins. The cement names as well, we think they're in a good position to pass on cost, some of the elements of the cost, and so we'll still be able to maintain margins. Consumers not so much. We think the telcos as well, from a volume perspective with improved subscriber growth, will continue to drive performance. So from a valuation perspective, that high earnings is making valuations look attractive relative to 2022. So we see PE settling at 7.9 times versus 9.3 the previous year. And if you go to the next slide as well, dividend yield looking more attractive given the improved earnings. And so if one is thinking about returns excluding capital gains, the outlook should be more positive from that standpoint. And the next slide, on the next slide, we compare Nigeria from a valuation perspective to a few other frontier markets. So looking at PE, still looking reasonably attractive. So if you compare to Ghana, compared to Ghana is looking more expensive, but one can understand why the Ghana market is depressed given the challenges the economy is having. Kenya, Egypt, the NGX isn't looking too far out. And so from an EM perspective, looking expensive, looking attractive as well. And if you go to the next slide, we show what dividend yield looks like and forward PE as well. And I think this slide is critical, particularly for investors that are looking at a broader market. So I suppose for this audience, you're limited to Nigeria, but I think that kind of helps to understand why Nigeria still kind of looks attractive for foreign portfolio investors, even though the FX situation continues to keep the market locked out. And so if you go on to the next slide, here we show how liquidity has trended, particularly from a foreign portfolio participation direction. And so last year, performance was pretty muted, but we've seen over the past couple of years, steady outflows from Nigeria from portfolio investors. And this is literally reflecting the difficult FX situation. We've seen backlogs built up for foreign portfolio investors. They've had to look for other means to take money out. So if you look at the next slide as well, we show equity holdings for foreign portfolio investors. So it's declined considerably. Almost 10-year average at 15%, but currently just above 6%. And foreign participation have pretty much collapsed as well at 16% in 2022 relative to historic levels of closer to 50%. And so one can argue that a key catalyst to a stronger re-rating in the market would be FX reforms. And so with a change in government and a much more business-friendly policies, more FX-friendly policies as well, that could move the dial considerably. And I think what's positive as well is that if you track the manifestos of the key candidates, they all talk about the FX market, all talk about need for reforms in that market as well. And so we see that as a very strong catalyst for the Nigerian economy and for the Nigerian economy and the equity market. And that could drive a stronger performance this year relative to even how well the market did last year. So if we go on to the next slide, here I think we talk about so here we're just showing that negative correlation between the NGX and interest rates. And I suppose Eyita will talk more to direction interest rates, but I think if one thinks, particularly from Rita's point of a much more tighter monetary policy environment, higher rates typically have a negative impact on the equity market and on equities in general. And so based on that backdrop, going into this year, we're more neutral, I'll say more neutral to negative, even though from a valuation standpoint, the market still looks attractive, but technicals, given the higher interest rate environment, could keep markets subdued. And so if you go on to the next slide, here I flag domestic participation, particularly pension funds. Oguche already talked to this in his introduction. And I think if you compare with historic averages and even previous high as well. You see pension fund holdings reduce considerably, and I've had conversations with a few of the key pension fund players. I think some are in this audience as well, and there seem to be that very negative view on the FX market, particularly going into this year. I think there's that strong position that given the high expectation or expectations that interest rates would be higher this year, they would rather be underweight equities or reduce the equity exposure. And I think there's also been that view that if you compare equity market performance over the years, you haven't necessarily seen strong performance relative to fixed income. I think there's that concern that there's been material volatility. And if given, I think what's positive is that in spite the reduced participation from the foreign portfolio investors, you've still seen the market hold up. So going into the year and expectations that we could start seeing some flexibility in the FX market space, that could drive some strong performance in the equity market. And the next slide also shows domestic participation, but for the non-pension funds. And I think what's interesting here is that beyond fixed income holdings, you see strong dollar holdings as well. And I suppose one would understand why, given the marked depreciation we've seen in the currency. And I suppose if one starts seeing reforms in that space and a change in direction, then maybe that appetite could reduce somewhat. And so one could also see maybe an increased interest in equity market once starts seeing a stronger foreign portfolio participation. I think the next slide should talk to sector calls. Yeah, sector calls and top picks. So from a sector perspective, we like the commercial banks and we also like the cement names as well. We think the cement companies are able to benefit from the elevated prices, and so that should support earnings to some extent. So even though high energy prices could be a dampener, but we think there's still a way to pass on those costs. So even though volumes might not grow strongly, but ability to maintain margins should be supportive. For the banks, we see them benefiting from this high interest rate environment. One has already started seeing expansion in asset yields and improvement in NIMs, in net interest margins. So this, in our view, should drive earnings growth as companies are also able to, as the banks are able to increase interest rates on loans. For the consumers, we're neutral, and also neutral the telcos as well. We think the consumers are at this point unable to push on most of the higher costs to the consumer, given the elevated inflationary environment, and that's having a negative impact on disposable income. And so we see margins still struggling for these names and inability to drive earnings. The telcos, we think a reasonable portion of the benefits from data, from higher subscriber base, and even mobile money potential is priced in. So one could see an upside if mobile money performs materially better. And it seems this Naira redesign policy as well could drive increased cashless activity, which could be supportive for these names. In terms of company specifics, we like Dangote Cement, we have a buy rating on it. We also like GT Co, Zenith Bank, and Nestle. So in spite of the neutral view on consumers, we see Nestle as at this point as undervalued, and we see strong potential in Nestle. We also see speculative opportunities as well in a few other banks, UBA, Access, and Lafarge Africa. So I'll pause here and suppose hand over to Wale.
I am muted.
My apologies, sincere apologies. All right, so I was just saying that valuable insight as always, Muyiwa. We'll move on now to quickly take Eyitope's presentation, and then we'll move on to questions. So just a brief introduction of Eyitope. Eyitope Olabi is an investment banker with over 13 years experience within the sales and trading division, helping clients to manage and mitigate risk in the Nigerian financial market, while also providing them with structured investment and funding solutions. He's currently the head of structured sales at Rand Merchant Bank Nigeria, responsible for originating and executing structured transactions across West Africa to corporates and institutional clients. Eyitope, it's over to you.
Hi, Wally. Thank you for the intro, and thank you for Oguche. Thank you for the invite. For me, I would just ride on the back of the good work of Muyiwa and Rita that have done, just setting the scene in terms of the macros, right? And from my perspective, I'm not going to do. I don't have a presentation to show PFAs, because it's going to be like I'm preaching to the choir, right? Telling them about fixed income products in the market. But if we look at the outlook for interest rates, and also what Oguche had touched on in terms of the allocation so far, and also what Muyiwa pointed out in his presentation, we see largely what of the PFAs have been investing in the government bonds and also a lot of the money market securities. And it's just on the back of the outlook for interest rates. With the way the market is at the moment, and the expectation for rates, and it's depressed currently, is a question of, are we adopting, or it's not a question of are we adopting a buy now or a delayed purchase approach towards this? Because where we see inflation and where the rates are today, it's a negative real return position for most people. And the interesting thing is, because we know the PFAs are restricted largely to government securities, the options are really limited at the moment. But what I want to do is really, for this few minutes of discussion, is to shift the focus away from just beating returns for a minute, and how we can stabilize and just basically improve the funded status in the near term. With the kind of allocation that has been going into the market by the PFAs and where rates are, the moment we see interest rate move, then that introduces some sort of volatility or risk into the portfolio, right? And the question is, how do we help address by these things? How do we help funds, help in reducing the volatility related to the prior strategies? How well do these funds gain enough asset to match their liabilities on the back of this volatility? I have a quick slide I want to just share, just to give you a sense of the 5-year return on volatility. Hold on a second. Just to give you a minute. Yes, can you see my slide?
Yes, we can.
Okay, yes. So it just basically speaking to what I'm saying, that let's shift the focus from beating returns. If you look at the last 5 years and using the S&P FMDQ Nigerian Bond Index, right? The red line you see there is the average inflation for the last 5 years, which is at 14.5. And the index in itself just beats the inflation slightly at 15.04%. But what I want us to just note is the volatility at the point at the 10% mark, right? And this introduces a lot of risk to the portfolios that what the PFAs are holding at the moment. And the moment markets begin to shift, and given our market as the way it is now, with the way interest rates are moving in the money market, and how the effect of the policies of the CBN is affecting what people are holding, I think I want us to be able to address things and begin to open our minds to the use of derivatives as the hedging instrument for the market. The conversation needs to be had, and PFAs need to be able to understand how much that can help in terms of managing the risk on the portfolios at the moment. Because one thing it does, it helps to free up capital to now increase what you can put in growth assets and also expand diversification. And for me, if you look at the established markets in Europe, in Southern Africa, where we also operate, we have seen how they've leveraged on derivatives to expand on what they have on their portfolio and also ensure that they have maintained and improved a funded status as a PFA, right? So the question I would like to put to the House, or basically maybe as we go into the Q&A, is to understand what are the fears, because one of our engagement also with market participants and players, I believe, is when you introduce derivatives into portfolio, it increases the risk. But over the years of working with these products, deploying it to market, we've realized that it actually minimizes risk and reduces loss. And also, when its use has started to increase, especially in Southern Africa, the values of the pension funds assets grew significantly, and the market were able to withstand different shocks. So, I mean, for as it stands for me right now, I think I would just like us to go into the Q&A and just to get a sense of what I believe would be helpful for us to have that engagement, to see how we can go back to now work on products that will provide and minimize this risk in the portfolio, and also begin to move ahead with Oguche and the team to begin to have the necessary engagement to allow for the expansion of products and to help the PFAs and also help the pension funds allocation to be well diversified. And this is not us saying it or me saying it without I'm oblivious to the fact that derivatives and the mark-to-market impact do have some impact on the market. And we've also seen something similar over the last month, I believe, in the UK as well, where there was a drop in the glitz and a lot of pension funds had to go for a bailout. But what we're trying to do with this is just to let you know that once you have these derivatives, it's supposed to help you to apply. You're supposed to apply it cautiously and not go gung-ho. We're supposed to use this to minimize risk only and to just help ensure that the funds in the care of the PFAs are able to deliver what it's meant for at the maturity, at the future date. Yeah. So, I mean, I'll pause now, and hopefully we can just begin to dig more into this and how we can improve, and also look at what way we can also take this forward as a market as we begin to explore new frontiers. Because, I mean, based on the macros and based on information shared, we are seeing a lot of restrictions. We're seeing a lot of little activities all confined to a small space. And we need to begin to expand the horizon for the pension funds and also begin to grow that market more and deepen it. Thank you very much.
Hey, Tokwe, thank you so much for that valuable insight into that perspective for investors. Certainly pension fund managers, I think, have some things to think about based on your presentation. So now we're going to move on to the interactive segment of today's program, and I will invite our speakers, if they can, turn on their turn on their video cameras, and I will invite our participants to begin to type in your questions into the Q&A field so that we can begin to interrogate some of the points that they have made. And as we do that, and while I wait for others to contribute their questions, I would like to begin by going back to you, Rita, and maybe getting your perspective on the implications of Nigeria and indeed several other sovereigns on the African continent being excluded from the Eurobond market. What type of, okay, let me backtrack and say that it seems to me, and it goes without saying, that many sovereigns will continue to need support with respect to their foreign currency requirements in those economies. So how do you see things playing out? What could this potentially mean for economic reforms that maybe some in the likes of the IMF may demand from these sovereigns before they can provide support? I just wanted to get your thoughts about the shutting out of the Eurobond market for sovereigns right now.
Yeah, Wale, thank you. That's it's actually it is the thing that we were fearing. We've been fearing for a number of years, right? Ever since I guess 2012, when we started seeing the first issuance coming onto the market. We always knew that there was an element of this being temporary. We know from research that it takes many years for countries to become repeat issuers, to become accepted within the global Eurobond market. And this is the experience of Latin America and Asia. And so actually, I think African countries have had a pretty good run, right? Which is almost a decade of uninterrupted issuance, and countries like Ghana and Kenya, especially, and maybe Senegal to some extent, Cote d'Ivoire, Nigeria, became repeat issuers. Now, I think what the market, we're in a situation where the market is responding to some, I mean, it's punishing bad performers. I don't think Africa is unique in this sense. From a kind of a fundamental point of view, what's happened to Ghana, and by extension, I guess there's a fear that there will be contagion to other Eurobond issuers. Some of that is based on fundamentals, but it's also sort of bad luck. It's what's happening in global financial markets. I think longer term, there is a fundamental question about how Africa continues to access hard currency with the structure of economies that we have, because we're still very vulnerable to these boom bust cycles because we export raw materials. This is it's an area of focus. If you're familiar with the AFC, you know that this is something that we care about very strongly. We think that we have to give countries the opportunity to change their economies fundamentally so that they're not vulnerable to these boom bust cycles that are related to commodities. And we're at the bottom. I mean, I guess we're not yet at the bottom of the commodity cycle, but we're at the bottom of a global sort of financial liquidity cycle, which means that essentially the markets are closed to us. There is a question of what happens from a financing point of view, because I think many countries in Africa, many sovereigns, face a hard currency financing crisis. We've seen what happened in Ghana. I think to some extent, Nigeria is in a similar situation, except the problem seems to be more homegrown when it comes to Nigeria. And the fact of the matter is that there are very few lenders of last resort for sub-Saharan Africa outside of the IMF. So I hate to not have a much more positive response, but I think if I were to sort of if I were to boil it down to it, this is kind of a long-term restructuring of economies to develop more resilience to funding, to the funding environment, which is really building your own, I guess, capacity to earn hard currency, even when commodity prices are not as high.
Well, I just get the sense that we're moving into an era of potentially a lot of desperation from many sovereigns on the African continent, but we'll see what happens. But moving back to Nigeria, and one last question before I go to the others, Rita, is on the Naira redesign and its implications for growth in the first half of the year. I was interacting with someone at MTN yesterday, and she clearly identified it as a huge problem at the moment, because it would be interesting to note that the most frequently purchased, if you like, bite size of airtime is 100 Naira. And if people are struggling to get 100 Naira, they may not buy airtime. So it does appear as though this Naira redesign could actually cause a significant contraction of the economy, perhaps short term, but I just wanted to hear your thoughts on that.
Yeah, I think when we look at the demand side of the growth picture that I was that I was kind of talking about earlier in my presentation, much of the momentum that we've seen post-COVID has nothing to do with the fiscal side, with the government side. It's all private sector recovery from COVID. And I think that in some ways, despite the fact that inflation was really high, was rising quite aggressively, I think what's happened on the monetary policy side, this accommodative environment has provided a bit of room and breathing space. So I feel like it's one factor that's now that's coming off. And I agree. I mentioned that we are vulnerable from a growth point of view. We're vulnerable to external factors because there's very little from a policy point of view that's driving a positive outcome. And the fact that the oil sector is pretty much out of the picture. So that's an additional factor, I guess, that adds another headwind. So I couldn't agree more. In addition to the fact, that liquidity extraction, I haven't quantified it, but it has to be significant. So yes, I couldn't agree more.
Right. Well, thank you for that. I would like to encourage our participants, take one of the questions that have been shared on the platform. Perhaps Oguche may want to take this one, and then we'll come back to our panelists. Now, Abdul Wahab is noting that we are seeing some government agencies planning to exit contributory pension schemes, and he would like to know what's the likely impact of this on the exclusion on returns on investment, and then what should PENCOM do to halt agitations for exclusions from contributory pension schemes. It does appear that this person thinks that it's a good idea to stay in those schemes, but there appears to be some pushback from some forces. I wonder if you have a reaction to that, Oguche.
Yeah, thanks, Wale. Well, I think it's the old fighting against the new. So if you look at telcos, for instance, we've spoken about some of the telcos, and there was a time where there was only one government institution that managed telecommunications, where people used to queue to make phone calls. But now it's in the hands of private sector. We're seeing growth, we're seeing investments, we're seeing listing, and there's a lot of growth. But people still want to go back to the previous ways, and that's with pensions also. With the pensions, we've seen the growth in the pension industry, second largest in Africa, 32 billion. We've seen the Access Bank, GTB, leapfrog, foreign companies coming to invest in the sector. But some people think they still want to go back to the way it was managed before because of government patronage, because they feel it's better, right? So the old will always continue to fight the new. And I think that's what is happening. I don't think it will happen because the government cannot afford it. If some sections of the public sector want to pull out of the pension scheme as we have it, the huge liabilities for the government will run into trillions of naira, and we can see that we don't have that based on the macros. So we don't think it will happen. That's our thinking, and I want to believe that that's the direction of the government, because the government had issued a white paper sometimes saying, they can't afford other people to leave the pension scheme the way it is. This system is contributory. Most people here, if you work in Nigeria, you have your RSA, you have your account there. And I think we need to make more noise about it, just be more offensive in touting some of the benefits and some of the things we are doing here to show how the accumulation of funds could help the economy. And that's, we need to do more. And that's, I guess, one of the reasons why we're here.
Yeah, thanks for that, Oguche. So another question, and perhaps Oguche, you will come back in to chime in on this, because obviously you are representing PENOP, but one of our attendees is saying, while the ideas of derivatives for pension funds is a good idea, the product is not an allowable asset class under PENCOM guidelines. And so does this call for some creativity in the product design? First of all, I was wondering if you wanted to react to that, if there could be some restrictions that could limit the use of derivatives.
Yes, we're well aware that regulation limits the impact, but the angle that we also want to be able to speak from is there is no clamor as well from it from the other side and just for the market generally. And once we begin to see how constricted and limited we are with what we have with the existing, then we need to begin to get accustomed with this asset class as people, even as pension funds, how much of our key decision makers know or understand how this works extensively, and also the impact of having not to hedge some of this exposure, these true costs, and not just the cost of just buying those products. And once that engagement begins to happen internally, it begins to bubble under, and then we begin to see more advocacy towards deploying this into the market. I mean, we saw sometimes late last year, NICOM introduced derivative as an asset class for investing in some of the shareholders' funds, and we believe that this direction to be taken, and it's a matter of actually when and not if, but also timing, and if the market players are also ready to engage as much as possible to deliver on this.
All right, so advocacy is the way forward here. Oguche, a quick comment on that before I come back to Itope.
Yeah, so I mean, just to thank people like RNB and AFC for supporting us on this, but there have been engagements around that, and advocacy from the pension funds, but also from issuers, because you will hear, and if some of the CIOs are here might want to speak, when I speak to them, what they say is, well, we don't see it in the markets. We don't see those products in the market. We don't see the push for that. And maybe that's true, maybe that's not. But for us to engage more with issuers and organizations like this to say, let's co-create. So we're getting into an era of co-creating, hearing from us, what do we like, hearing from you guys, what's available, and then advocating with the regulators. That's the way to go.
Yes. And back to Itope. Thank you, Oguche. Can you identify some low-hanging fruits here in terms of potentially, maybe you can use such an example of what you think can be created that could be valuable?
Agreed. Thank you for that. I was open for that question. That question will come up some way. And I mean, I can speak directly to one that we currently deploy in Southern Africa, right? And it's something called the bond rebalancing swap. We also had a little roadshow around this sometimes last month in country when we got the NICOM guideline revision. And the whole idea around this is to help PFAs or clients in general to match the liabilities with their assets properly, right? I mean, if you look at what they have right now, is mostly buying bonds and not necessarily matching the liabilities as much as they can, because those bond maturities are based on government. What we tend to do with these swaps is to where if we take those bonds from you, or we take the funds from you to buy those bonds, and then you give us the payment profile, and we match those payment profile on the back of your liabilities, and we take on the risk of ensuring that we deliver the cash when you want it at what time. And the modalities of that can be discussed in terms of, are you taking on the bank's risk, or where is the risk sitting on because you have given me the bonds? But that is part of why advocacy is important, and yet additional discussions can be done in ensuring that we can iron out whatever concerns there is. Also, there's also the possibility of also even looking at the money market as is right now. There is no appetite for just something as basic as repo. And we believe that if you look at the market in the last 1 year, 2 years, the opportunity to enhance returns has been there, but PFAs are constricted and limited by what allocations they can give to banks as fixed deposits. And in the repo market in itself, if you look at it from the fact that you are giving Naira to collect securities, it's actually minimizing your exposure from a clean deposit angle, right? So those are the little engagements on places where we can begin to have the right discussions to know what the PENCOM guys are, what PENCOM in itself are looking at in terms of what they want to see, and how we can make this product or this solution within that risk limit or within the risk tolerance. At the end of the day, it's our money as well that is being managed. So we want to ensure that it's being managed properly.
Yes, indeed. I think everyone has a stake in this. Thanks so much for that response. Let me go to Muyiwa now, and I'd just like to link this to a question that has been posed here about PFAs. Some of the funds that PFAs manage are low in terms of their exposure to equities. So I wanted to, first of all, get your perspective on what concerns you the most in general in terms of the macro and business environment going further into this year. that could potentially be concerning some of these fund managers as well. One point that I want to echo again is this Naira redesign and its impact. Obviously, when we get this economic data, they lag the times that they're needed for. But I am willing to bet that we are going to see the impact of this in the Q1 GDP numbers. But I wanted to hear your thoughts. Anything else?
Yeah, so I suppose there are quite a number of risks one would say, particularly when you're looking to macro risk, but also looking at how that affects the equity market. I think the key one and the key overhang is still the FX environment. And this is really not just talking to how it affects portfolio investors, but even the corporates as well. So it's still having a negative impact on FDI and FDI trends. Most corporates operating here, particularly those that have parent companies offshore, and at some point we need to outflow funds, still struggle to repatriate dividends. Even on the raw material side as well, you typically will have to queue to access FX in the official market, or have to operate at the closer to the parallel market levels. And all this is still, I suppose, contributing to that inflationary pressure. So you'd say FX is a big risk, inflation also a risk as well, and how that seems to have a negative impact of how companies are able to maintain margins given the low disposable income level. And I would say the regulatory environment also seemed to be quite difficult and to some extent uncertain as well. So if you look at the banking sector, there seemed to be a very heightened, overbearing regulatory environment, and that's had negative impact on bank performance over the years. The CRR regime is extremely difficult to predict, and you continue to see treasurers run away from funds, which I would have never thought you'd see a banking sector where, as a banker, you'd be running away from deposits and liabilities. And that's, I suppose, is driven by the extremely difficult regulatory environment. And I suppose that's why there seem to be some element of hope with the coming elections as well. You're hoping that will maybe drive a change in the regulatory environment. So if you have a more business-friendly government, and then one will start seeing policies that will be far more pro private sector. So to Rita's point, the private sector has really driven the recovery we've seen so far in the economy. And this is in a, I think, lack of a better word, disabling environment. So if we have a far more enabling business environment, that could also spur and drive stronger growth as well. Wale, does that address the question?
I think.
Go ahead, please.
It seems we've lost food. No, so I was just ending on that point that I suppose with elections, if one is able to elect in a more business-friendly government, then one could start seeing a more positive business environment. And I suppose if one links it to the question on the strong returns one has seen in local currency terms over the past 10 years, and how I suppose pension funds have still limited exposure, I guess there's still that concern around, or preference for, predictable returns to a reasonable extent. And I'm not sure if I'm speaking for all pension fund operators per se, but it seems that there's that stronger preference. And I think also the exclusion of foreign portfolio investors in the market as well, limited participation, seem to have reduced interest from pension funds. And that seemed to be my own sense, engaging with a number of the pension operators. But I suppose Oguche can also maybe talk to that point as well.
Oguche, do you want to chime in at this point, or I actually have a follow-up question for him?
No, yeah, you can go with your follow-up question. I'll
okay.
comment.
All right. So here's another recurring view that I'm seeing as we all preview 2023, and that's the fact that things are likely to be tight in the first half, but there's that optimism that because all the candidates seems to be pro-market, pro-reform, that things can only get better in the second half. So I guess my question is, how much better? Do you foresee, for example, Muyiwa, that we could see a huge rally in the second half of the year, and what potentially could drive that?
I suppose maybe a positive is that the market is typically more driven by sentiment. So expectation to a reasonable extent drive market performance. So if one ends up with a candidate that the market, and there's some consensus view that most of the policies that might come out at some point will be positive, then one can start seeing a strong reaction and performance. So if you recall in 2015, post-elections, there was that strong rally in the market when this current administration came in. And part of the expectations at the time was that some of the corruption and very weak inefficiencies or poor inefficiencies that we had seen in government could be addressed with the administration. But I guess it's a story for another day at this point in time. But if one looks at these candidates, and I guess the realization as well, and to Rita's point, that we really won't start seeing any reasonable reforms or messaging from the administration until later in the year. The National Assembly will only be sworn in outside the candidates for ministerial appointment and so on likely will come in maybe in the third to fourth quarter of the year. And so in terms of actual policy comments and direction, one might not see much this year, but I think just the candidates and I suppose commentary and rhetoric from the candidates in the past could drive some elements of sentiment. And so if there's just that overall optimism, I think that could lift the market from where it is. And the reality is that there seem to be some low-hanging fruits as well that could address market direction and market liquidity beyond these more longer term reforms that will really pick up the economy. So if the FX challenges and issues and reforms is addressed, that I believe is something that can still be done this year. That in our view can be a single game changer in the direction of the economy, of the stock market, I mean.
Okay, all right. I'll wait for more questions from our participants. I'm going back to Rita now because I think Muyiwa has highlighted one of the biggest issues, which is around foreign exchange. And I wonder, Rita, your perspective on the scope for reform and the impact of that reform. There is a feeling that to move away from these unorthodox policies that we've seen the central bank embrace over the last few years, it could be somewhat rocky. And it also takes some courage to do as well. So I was wondering if you just get your perspective on the challenge that may be ahead in terms of foreign exchange reforms.
Yeah, I mean, that's a difficult one. Why you had to pass me the hot potato?
I thought you could take it.
So
right.
this is
we want to see your thoughts on the tough questions because this is what people want to know.
Yeah, it's the perennial question, I guess, for Nigeria. What does a future adjustment look like? That's a bit more of a shift, a fundamental shift that will fix the market once and for all. And to be clear, somebody mentioned that all three candidates, or maybe I did at the beginning, and someone concurred. It's true that all of the three candidates have said, or the main candidates, have talked about FX reform, but nobody has talked about how. And so it's an open question. How would a new reformist government go about this? And it's not one that I'm going to try and answer on this call because I don't. I can't. I can't. I would only be going ahead of myself. But what I will say is that it seems to me like on the subsidies, that market forces are actually inevitably going to engineer some sort of adjustment that there is, where sometimes you get the sense that we're coming to the end of the road. And this is the case, especially with this economy's ability to attract hard currency. I don't think we've seen a year like this. I don't think we've ever had a year where oil revenues and FX inflows were as low as they were. Mind you, we haven't had FPI inflows for a number of years now in any kind of substantive way. FDI has fallen off very sharply, and essentially, and now we cannot, we don't have Eurobond issuance, and it's almost as if we're coming to the end of the road in terms of the ability to sustain the current regime. Now, what happens on a temporary basis? I mentioned in my comments that I think we've just, or when I say we, I mean when you look at the current state of the FX regime, I think we've bought a few more months maybe with the liquidity extraction via the redesign, but presumably that gets normalized at some point. It's just a very short period where there's a liquidity gap. So that gets normalized. The impact of policy rates maybe starts to kick in down the road. So we would basically need much tighter monetary policy to be able to sustain the regime much further. The broader point I'm making is that I think the economics is slowly forcing the economy into a position where this, you can no longer roll the ball down the road, essentially. If that makes sense.
All right, I hear you. And stay with you, and I think you can give a short answer to this. Philip is asking, what will be the impact of the Moody's downgrade on Nigeria's borrowing plans for 2023, given the huge deficit that is at about 10 trillion? I'm guessing you already mentioned, we're not planning to go in there, right?
We're not planning to issue externally. But what I think will affect the deficit, I mean, we're in line for fiscal deterioration, as you can imagine. But I think that the tighter monetary policy environment is probably a bigger factor, because it's the domestic financial sector, that's being asked to step up and finance the government. There's also this legacy issue of what happens to the central bank past advances and whether or not those get securitized. But I think the more important question for the fiscal is whether or not we will see the successful removal of subsidies. It's something that the 2023 budget assumes from H2 onwards, because if that comes off, it provides a lot more room, okay? But I guess, like many other things, that's unknown, depending on, on what who becomes, what new government we get.
I think you hit on a very important point, that the budget assumes a removal of the subsidies, but will they actually be removed? Because if they're not, then it actually expands the deficit a lot more, doesn't it?
It does, but hey, Wale, so like my point on the FX, I feel like the market dynamics are forcing this. We started to see fuel prices rise in the last month. I think towards the end of December, you saw fuel prices pick up, domestic fuel prices. The implication being that the subsidy wasn't able to cover, or there must be some arrears there. And over time, it's getting more and more difficult to cover this subsidy. So it's inevitable that in some way there will be an adjustment. Maybe not the full adjustment, but there has to be some removal, just because we can't afford it anymore.
Well, I have one or two questions that have come through from my end, which I just want to go to one or two of the panelists.
Yes, please go ahead.
So another hot potato for Rita, what would you say to a pension fund that is concerned, looking across to its neighbors, Ghana, and looking at its book and saying, I'm holding 65% of my assets in Nigerian government bonds, which traditionally at the safest, what would you say to them? Is there a possibility that the Ghana effect will happen in Nigeria? Should they continue buying the bonds? I mean, just what would you say, Rita?
So, okay, so here it's obviously Moody's thinks the current rating right now is a default rating. They're basically positioning the rating for default. They think that at some point in the near future, in the next 18 months or beyond, they will see a default. But the question of whether or not the sovereign is in a position to default, I think we all probably have views on that. And I'm not going to put myself on the line on this. I think they're in a very stressed position when it comes to the capacity to service debt. Like I mentioned, we're not really seeing a huge inflow of FX. The FX debt service requirements are not too significant, but countries default by accident all the time just because there's a mismatch in the cash flow. And I think that there's a very strong need for careful management of the kind of the liquidity and financing picture in the near term, just because of how stressed the position is at the moment. That's all I'll say about that.
Interesting.
Okay,
thanks, Rita.
I do think there's a strong.
I think we'll take one more question.
Okay. Sorry. I would add that maybe the capacity to service debt has fallen, right? Because revenues are falling off, but the the willingness is strong. I think this is that there isn't a recent history of default, and you have to look at that as an important factor as well. That they will they'll find a way to service the debt.
Right. Well, thank you for that. I'm going to go to Oguche, and this perhaps has to be intervention. So Modestus is asking, we have seen continued growth in pension assets. How does this reflect in the payout to retirees, looking at rising inflation and growing poverty levels among Nigerians? I think I'm not too sure how to handle that, but Oguche, do you want to respond to that?
For instance, last year, the pension scheme added about 333,000 new contributors, right? So when the pension assets are growing, meaning that they're adding new contributors, we can't take money from new contributors and pay someone, it's in your account. So it's the money in your account that you get paid. And the ways to get paid are if you lose your job, and many people are getting paid. If you retire, many people are getting paid, or if unfortunately you pass on your relatives to get the money. So many people are getting paid. I think the challenge with Nigeria has been the pension scheme is more or less the only form of social security. And we always go back to this problem, and perhaps in Africa, especially in Nigeria, where we punish people that are doing well, right? So I always say that if you earn 100 naira every month, for instance, as a pension, 8% is taken from your salary to your pensions account. About 25% is taken from your pensions money to the government. But everybody's looking to that 8% that has been taken, has been managed well, and is growing and is getting investment returns and is being managed well. They forget about the 20% that has been taken from the government year on year. How much has been taken from us in terms of taxes? If you look at your pensions account, how much you pay in pensions versus how much you pay in taxes, that question should actually go to the people that are taking taxes, because they're taking about 3 times to say, okay, so what are you doing for rising inflation? What are you doing in poverty with that money that has been taken? And I think we need to demand more. And I guess we spoke about the candidates who are pro-business. We need to demand more and not just all focus on this pension funds alone. That's my answer for that.
All right. Well, thank you for that. I think on that note, we will call it a day. I want to thank all our speakers for their contributions, and thanks to our audience for participating in this. Many thanks, of course, to PENUP, but I guess I will allow Oguche to have the final word here.
Thanks, Wale. I see Muiwa laughing when I'm saying we need to demand more. I don't know how much taxes he pays. But yeah, it's really that we pay quite a lot of taxes and we need to demand more. So just feedback to the journalist. But thank you, Aitokwe, and Rita. Great time. I've got one more thing to say to the audience. I just got about 5 more minutes. So please, can I ask you to kindly put my presentation on? I just want to share 1 or 2 things before I give the final word. But just thanking the panelists at this point. I'll still do that just at the end, but I've got about 5 more minutes or so to go. Okay, can the team please share the presentation? Yeah, so quick one. We've just got some insights from pension fund managers. So Eichokwe spoke about the need to look at other asset classes and to begin to think differently. And I think that has been the strong message from here, just in terms of what else the pension funds need to be looking at. And we have 1 or 2 insights to share, just in terms of what they're looking at. I kindly go to the insights slide. Yeah, thanks. So the when I engage with issuers, one of the things that comes through is they think the pension funds are homogeneous, that they all think the same. And Nigeria's pension industry, we've got about 25 pension funds, and not all of them think the same. For instance, in a recent poll that we had, about 42% of them are looking to invest in infrastructure, right? This is their desire, and so they are really looking for infrastructure deals, and about 50% of them are willing to consider those investments. So it's something that they're looking for. 67% of them are willing to invest in private equity, even though cautiously, but that is above 60%. 75% of them are actually looking for impact-focused investments, but they want transparency and they want the right structures. So we see that there is a move towards infrastructure, private equity, impact investments, and even diversifying their portfolio. So that is key. In addition, they'll be willing to participate in beauty parades with various issuers. So we're just polled the pension funds, and we wanted to just engage the market to say, this is what is coming from them. Sometimes what you see is there is knocking on the doors of the pension funds, and you haven't even understood what they want. So you're selling them what they don't want, and of course, the next time you come at them, they're not going to open the doors. So there seems to be that madness, and I just call it bringing the method to the madness, and something that we want to do, especially this year, just engaging issuers more. So this event, we'll have more of them, just themed events, knowledge sharing sessions, roundtables where we bring issuers, potential issuers, investment banks with the pension funds, and we get the pension funds in the room that want to listen to you, because we've sort of engaged them to find out what exactly they want. There's no point speaking to a pension fund who doesn't want to invest in infrastructure and going through your slides and engaging, it's no point. So these are some insights we have. Next slide, please. So the next slide just focuses a bit on those insights, and we will send this across. Next slide. So we had said the pension fund managers are looking to engage more with the market, and what to look forward to. Like we said, we hope this year to engage with the market in a more structured manner, whereby we can have things like a pitch calendar, and where we can have structured pitches to the pension funds, as opposed to, everybody knocking on the same door. And even with the regulatory authorities, to be able to see the calendar of issues that are coming so that they can plan. I mean, something happened in December and, you get calls to say, oh, I've got this deal, pension funds can invest, they've got lots of money. And pension fund says, well, I've locked my investments for the year, I don't have liquidity. So people always feel that the money is there just to invest, and they don't know the pension funds have to plan, they've got payouts. So there has to be more structure, I think, in this, and PenUp is willing and looking to do that. In addition to the insights I said on pension fund investment activities, we brought some insights, but also just what are they thinking about? And even when you do pitch, to be able to come back to tell you that, they didn't like this because of this, right? And they don't just ghost on you, you've got information. So we're working with the pension funds, and we want to work with the market. Like I said, sectoral events. We're going to bring in some research reports this year also, industry reports and some sectoral reports. And we're going to be working on an annual conference this year, sometime in the second half of the year, when hopefully you said the minister's coming and there's a lot more activity and there's a bounce. So we're looking to work with the market, so if you looking to speak at the conference, sponsor the conference, partner with us on the conference, or on any of these issues, please get in touch with us. Myself and my colleague Aki, our email addresses are here. But also just thanking RMB, thanking AFC, thanking Stanbic for supporting us at this event. Thank you. We look to engage more with you guys. RMB has spoken about derivatives and some other options with the pension funds. AFC also infrastructure. So we look to engage with you guys and the pension funds to hopefully diversify their assets. And also want to thank a very important crew, the pension funds. You guys rock, and you make this happen. Ultimately, some of the CEOs are here, many of the CIOs are here. You guys, what you do daily ensures that we've got those monies in our accounts to retire to. So thank you a lot, and that's it for me. I dropped my mic. But also check your pensions accounts, demand more from your PFA, and let's demand more from our governments. Thank you. Wally, you can close us out here. Thanks.
Yes, said as a true advocate for the sector. Thank you so much, Oguche. And again, just a short close. Thank you to everyone for participating in this interaction. I hope you have found it valuable, and we look forward to the next event, as Oguche has clearly shown that there's still more to come from PenUp. So on that note, I would like to say thank you for joining us again, and enjoy the rest of the day.
Thank you. The recording is on YouTube, so you can also watch it on YouTube.